Rochus Appert is head of intermediary business and Spider ETFs at State Street Global Advisors in Switzerland. He joins us here at Investor 13 to discuss investors' behavior and best and worst performing assets.
Hello, very pleased to be here. Thank you very much for having me.
First question, what is driving the markets at the moment? What are the main drivers?
I think we have still to consider where we are since the crisis in 2008, and that is that the national banks have still provided massive liquidity in the market, and that is one angle which drives the market. The second angle that drives the market is that companies have to find markets where they can sell their products. And as we see that growth, that the GDP growth was not so substantial, companies actually tried to minimize their cost and streamline their balance sheets. So there are two areas that actually drive the markets. One is still the national banks with their massive provision of liquidity, and on the other side it's the companies that try to optimize their operations.
Investors have changed their behavior dramatically over the last few years. Can you explain what is different from, say, 2008, 2009 and now?
Yes, investors have realized that equity markets do take an enormous volatility, and then while they can gain a lot of money in equities, they also can lose a lot of money in the same equities. So they started to find areas where they can invest in that they don't lose money when markets really plummet. So that is one behavior change. They rearrange their portfolios in a different way. That is one way. And the other way is that lots of investors just said, I don't want to be part of this game anymore. And they withdrew all their money. So they went into cash. So it's still an environment of, I wouldn't say fear, it's still an environment of concern about not losing further money and finding the right places to go to.
And what are the best and worst performing themes at the moment?
So like in the beginning of the year, everybody thought that it's going to be the US, it's going to be Europe, and it's also going to be emerging markets. Now, emerging markets clearly have way underperformed, and actually emerging markets, both on equities and the bond side, have severely underperformed and lost up to 10%, sometimes even more. If we go to the equities market, then the US has had a very nice performance because the companies there really own their markets, and they could demonstrate that even in difficult environments, although they did not have massive top-line growth, they could manage their operations in a way that they have quite substantial bottom-line growth. And then on the other side is also Europe. Europe actually, year to date, it hasn't been the case at the beginning of the year, but now year to date, Europe is the best performing market. So European small cap is in their range of 23-24% performance year to date. And then you have all these European sectors, for instance, consumer staples or healthcare or consumer or financials actually have done very nice since the beginning of the year until now.
Rochus, thank you very much for joining us today.
No, it was my pleasure. Thank you very much, too.